Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. Let's start the show, but I would like to give you some hints to understand which company we are calling in our KYC show. The first is, it's a North Indian based cement company. Of course, a larger name. We are getting this in KYC, but we want to know more details about it. Also, the second hint I would like to give you is the company recently came out with its Q3 numbers also, and volume growth has been strong. Cement industry, last 1.5 to 2 years, there was muted, you could say, demand and pricing pressure and also consolidation. But let's see what happens in this company. The third hint, let's talk about that. That is that stock has done really well. Seeing how the markets have panned out, the stock was up 29% in the last 1 year. That means some institutional activity is definitely happening here because the retail numbers are still on the lower side. Also, apart from this, another important hint is it's backed by Fidelity Group from the FIs, which I checked, and a lot of DIs are already invested in the company. So, pretty interesting name. So, I would like to give you one more hint. It rhymes with, a state in the northern space as well. It's called J&K, Jammu Kashmir, but that's what we have given in social media handles. And the company in focus is J&K Cement. The company is JK Cement, which I'm talking about, which will be understanding about the company. And of course, the first and the most important thing is the Q3 earnings. What actually stood out amidst a weaker kind of a setup which was there for the cement companies. But apart from this, let's know why we are calling this company in KYC. Of course, the most important reason is definitely the earnings which is there and how the volume growth has panned out. Of course, some pricing pressure was there, but has that actually improved going ahead? The first thing we'll understand is we'll decode. Is it the volume growth or the pricing pressure? Where is the company actually in currently? Will the company start taking pricing hikes? How's the demand scenario looking like? And that's why we are getting JK Cement in KYC. Another reason is, of course, the margin outlook and the declining raw material cost. Especially there is a crude is on the lower side, and the raw material costs are also, you could say, benign. And that's what helps the operational margins of companies like this. And it's fully backward integrated as well in the grey cement category. That's what I'm talking about. And overall, the pricing and demand trend, this is one of the most important things you need to ask a cement company regarding their growth outlook ahead. Also, apart from the pricing and demand trends, we will be asking about the company's capex plan for 2026. A cement company, the capacity utilization is very important to understand, and also how the capex plan goes ahead for the next 2 to 3 years. That's what you should be analyzing for a company like JK Cement. And also on the show, we'll have Anuj Khandelwal. He's the business head of the Grey Cement division, where we'll ask Anuj all these questions regarding the industry, where the company is, and the growth outlook forward as well. But to give you more perspective, let's talk about more details about the company. And yes, there will be Q3 numbers also which will be discussed. And let's get to know what the company is all about. The company is engaged in manufacturing, selling of cement and related products. It's a very basic. Also, it has over 4 decades of experience in cement manufacturing. It is a kind of a legacy brand as well. You could say the market capitalization is roughly around 45,000 odd crore rupees currently, and it's among the top 10 grey cement manufacturers in India. I spoke about the segment of grey cement, and that's where Anuj also comes in, as he's heading that segment. Apart from this, the company is the 5th largest cement manufacturer in North India, so they have got important capacities over there. But the question is, are the capacities actually on the overcapacity side? That's another question we'll ask Anuj. The company became the 6th largest player in the central region as well. That's where the expansion is happening, from north to central as well. These expansion projects are progressing well. Last time we checked with the management, and now we'll understand what's the incremental moves coming in from Anuj. They commissioned recently 1 million tons per annum of cement grinding capacity at Prayagraj as well. So commissioning is also happening, and interestingly, an additional grinding capacity is also being commissioned, and this happened in January 26. So recently commissioning news flow coming in, and now the Q3 numbers also. Looking at the plants, 3.3 million tons per annum of clinker capacity is there, and this is coming at Panna. That's been commissioned in December, so not much time gap coming in. 3 million tons per annum split grinding unit coming in Bihar. That's also progressing well. So we'll be understanding when is the closure happening, and Bihar grinding unit, that's commissioned by the end of FY26. So we are almost towards the end of that. 4 million tons per annum clinker unit and 3 million tons per annum grinding unit coming in at Jaisalmer as well. So these are the largely expansion plans which I'm talking about, and this is the commissioning date for this segment. Apart from this expansion plans, the most important thing is the Q3 performance. That's what the street is looking out for. And look at the momentum, and remember, this is setting the stage for the other cement companies as well, especially which are north-based and central-based. Revenue is up 18% on a year-on-year basis, coming in at roughly 3,500 crore rupees. So that's a good growth coming in. EBITDA, this is a very important parameter when you are tracking a cement company. It's an asset-heavy business, and the operational gains is 13% on a year-on-year basis. So that's also a good improvement coming in. Margins, it's largely flattish, a slight dip coming in. We'll be understanding from the management why this dip has happened. But net, the numbers have been on the stronger side on execution. The concern definitely comes on the net profit front. Are there any one-offs, or is there an impact coming in for a lower profit? That's down 8% on a year-on-year basis, but still, you could say 175 crore rupees of profit coming in. There is a statutory impact. That's what I was talking about. There was a one-off impact, and that is why it's around labor codes, the new labor codes which has come in, and that's impacting all the companies, and it's largely factored in by the market. So do not read much into the PAT numbers. It's on the higher side if you adjust this 46 crore as well. The con call highlights is very much important, and a very bullish tone has come in from the management. They're witnessing a strong demand in the central India front, and also apart from this, the FY26 volume guidance, they have maintained it at 20 million tons. And third important thing from the con call is that the industry demand, that's expected to grow between 6 to 8% on a year-on-year basis. So of course, there is a strength coming in the con call as well. And the March quarter, they have stated that it will be one of the most strongest quarters coming in. And that's why the cement stocks are also buzzing because of this news flow coming in. 12 to 15% CAGR volume growth is expected over FY26 to 28. That's what the management has stated, and these are the important con call highlights coming in. Let's look at the capex guidance of the company. FY26 ranges between 2,500 to 2,800 crore rupees, and now the big one is coming in FY27, and FY28 is roughly 1,000 to 1,200 crore rupees. So I've given you the entire picture what you need to analyze the stock, but let's understand what is the show KYC all about. There are 8 ratings where we judge a company, and of course the financial parameters are included in it. This also includes the return ratios, the cash flows, and apart from that there is street cred, the amount of returns which have come in various time pockets, and also the shareholding between institutions, retail, valuations. I compare that with the peers, and the most important thing is the outlook. But let's move on to the first category, which is very much important, as the income statement. And remember, the Q3 numbers I've already discussed. So in our analysis, you will be getting 9-month FY26 numbers, and net the 3-year CAGR numbers. The top line has been strong, but I had explained to you earlier, the last 1.5 to 2 odd years, there was pricing pressure, competition coming in, consolidation, and that is why it impacted majority of the players as well. So net, looking at the numbers, and of course I'm factoring in a good strong Q3, I've given a neutral rating when it comes to JK Cement. Also, now let's look at the balance sheet. What happens here? The shareholders equity, that's around decent, 6,481 odd crore rupees, and the debt equity ratio is also very decent. You could just pull that up as well, and it's very decent for a company like JK Cement when it's on its path to expansion as well. Cash bank balance also very stable. So for a company and a good parentage, I would be giving it a very strong thumbs up when it comes to the balance sheet. So we spoke about income statement, we spoke about balance sheet, but cash flows are also very much important, and how a company manages its cash flow is something which I judge a company. And look at it, 3-year CAGR cash flows has done really well, 30% growth coming in, and the net cash flows, stable payment terms, and it's really good for a cement company. So of course, on this analysis, I will be giving this a strong thumbs up as well. So apart from cash flow, ROC numbers are very much important, and for a company like this, generally a 14 to 16% ROC is a very decent level which a shareholder should command, and that's what the company is delivering. FY23, of course, there were some gyrations. It's on the lower side, down 10%, but then it has maintained itself, and this year itself we can expect the FY26 numbers to be around this number. And of course the ROE numbers also, that's also on the higher side, slight trimming definitely coming in. So net the return ratios are strong, and remember, company is doing a heavy capex in FY27 as well, so there might be some pressure in the return ratios next year going ahead. But if you're a long-term investor, the story remains strong, and because of the story remaining strong, the return ratios have given a strong thumbs up. Apart from the return ratios, let's talk about the shareholding pattern, what happens here. And I've spoken about Fidelity being backed by the company, and the FIs, look at that, it's been stable at 16%, but a 3% chunk buying happening this year in September 25 numbers. Remember, December numbers are not out yet. DIs, however, have been losing, so there has been an exchange here, and it's very low, public float as compared to others. So net, it's a very decent and a neutral setup, and FIs are definitely showing more interest in the stock. So that's a neutral rating when it comes to the shareholding pattern. But let's talk about the street cred, how much returns the stock has given to the investors. This is an industry specific problem, and last 1 month, of course, the stock is up 11%. But if you take 6 months or 1 year basis, that's where the movements change. 6 months basis, if we could just pull out how the street cred has happened, and that's where we'll see the action taking place. But remember, for the last 1 year itself, there was a 29% gain. See, this is where the industry consolidation is happening, because during this time, cements and companies were not giving their price hikes. And even if price hikes were coming, the demand was not strong, so they were coming back. There was a pricing pressure coming in. Year to date, nothing much to share, but yes, Q3 numbers have aided this move, and last 1 year, significant move, almost 34% currently. But it's been a multi-bagger. If you take the last 5 years view, 182%. So net, a neutral rating. But now let's value a cement company, and when you value a cement company, you take the multiple of EV to EBITDA multiple. Of course, there's a lot of assets involved, and that's why we have taken it. It's a 12-month for valuation forward. We have taken JK Cement stands at roughly 17 times. Compare that with the larger players, Ultratech and Grasim, that ranges between 14 to 19 times. Let's pull up the other peers also for JK Cement, apart from Ultratech and Grasim. These include, of course, Shree Cement and AC and Ambuja Cement as well. That's where also we see the 12-month forward EV EBITDA numbers. So nothing much to actually understand from this. But remember, these valuations are still cheaper than what the numbers we saw in 2024, and as such, the industry itself has compressed, so have the valuations. That's why the valuations I have given a neutral rating. Apart from valuations also, let's move into another important factor, and that is the outlook. For a company like JK Cement, the outlook is very much important, and the management is still sticking to what they had stated earlier. They are aiming the grey cement capacity of 30 million tons per annum by FY26, and that's not unchanged. The trade prices, they have not increased, but the pricing pressure, that has eased. So that's a positive statement coming in. Also, the third part of the outlook is definitely that the FY26 volume guidance, that has also been maintained at 20 million tons. So 3 important outlooks already coming in, and the fourth one is that the medium-term outlook, they are expecting a 12 to 15% CAGR growth, and this is spread across 3 years, FY26 to FY28. And the last one is that the industry demand growth, that's expected to range between 6 to 8% on a year-on-year basis. And largely the Q3 numbers which I checked, the volume growth was better than the industry. Now this volume growth, that's going to be around 22.5 to 23 million tons in FY27, and after that it will be 25. That's what the company had stated when it comes to the con call. So net, a very strong thumbs up when it comes to the outlook for JK Cement. But let's just sum it up what we have done in KYC across our 8 parameters to give the final KYC rating for JK Cement. The first one, of course, the income statement, that's been largely neutral, but remember, Q3 numbers were strong. Balance sheet very strong, cash balance you beat, or the working capital management. Cash flows is the result of what I just spoke about, and return ratios, they have been very decent, is what an investor in a cement company would like. Shareholding largely neutral, but FI holding has increased. Street cred, near-term basis, nothing much has happened, but last 1 year, despite a bad market in be it the cement market or the mid-cap space, the company has done well. Valuations, all of the valuations have compressed on the EV/EBITDA multiples for the cement companies. So largely, it is still, you could say it's decently priced, and outlook is something which I'm very bullish on. That's where the management also has spoken, and they've kept their guidances going ahead as well. So any kind of a private capex pickup, any kind of a demand pickup, and that is where the company gets the good momentum. And right now, one of the highest rated ratings I have given in KYC for JK Cement, it's a 6 out of 8. That's what is something which we'll be focusing on. But let's move on and understand more about the company. And before that, we'll be introducing Anuj Khandelwal. He's the Grey Cement division, and he has been associated with the company for the last 2 years. But interesting profile he has. He has been there 13 years in BCG, the Boston Consulting Group. He has been the partner and the managing director as well. So a very strong consulting background. And of course, that comes from a pedigree, an MBA from IIM Lucknow as well. So joining us is Anuj Khandelwal, business head, Grey Cement division. A warm good afternoon to you, Anuj, and a very strong set of numbers coming in. And two things have caught my eye. One is, of course, volume growth has been industry beating, but on the other hand, the pricing pressure is definitely there. So I need your views on both of them, Anuj.
So firstly, Sharad, many thanks for having me on this segment, and you've given a very comprehensive overview of the company as well. In terms of volume per se, we did more than 20% growth in grey cement in Q3, and even on a YTD basis, it remains strong at around 17% or so. Q4 is an important quarter because we are well set to meet the 20 million ton target which we had for the year. We are aiming a double-digit growth again in Q4. It's very early days, but started well. In terms of the next year, we again want a double-digit growth. We are targeting around 22.5 million to 23 million tons. As far as the pricing goes, look, after Q2, the prices of the entire industry across regions did correct to some extent because October and November were low demand months. December was a good demand month, and in January, given the demand, the support of the demand, we've recovered some of the prices which we had lost in Q3. So overall, things are stable. It's buoyant in terms of volumes, but in terms of pricing, it's quite steady.
All right, the pricing is definitely steady, but let's just take the labor cost impact with a pinch of salt. Going ahead, the margin outlook for the company, because I remember that the raw material costing, that is also coming down for the industry. I'm just taking the crude derivative as a benchmark, how it has come down and how it actually impacts the cement division. So if that is happening, raw material costs, are they declining? And if yes, margin benefits coming in the coming quarters?
So there are you rightly said this industry is like many others, cost is a very important factor. We are looking at cost both from the raw material sourcing side as well as operational efficiency side. And we, a couple of years back, targeted around a 150 rupee per ton saving. We are happy to say we are going to realize around 125 rupee per ton already now. In terms of raw material sourcing per se, our dependence on the central region is increasing, which is more coal fed. And given the government support in removal of cess from coal, it has helped us by reducing the coal cost. Overall, given that the country is quite sufficient in coal production, it also helps our sourcing strategy as we have more and more exposure to the central India. As far as North and South India goes, it's still dependent on petcoke. Petcoke last 2 months, 3 months, the prices have been slightly higher. Normally, last 1 year has been averaging around $110, but now it's around between $115 to $120. So slight increase, but a manageable increase per se. But overall, we are also investing in a lot of operational efficiencies so that beyond the sourcing changes, we are able to get the cost efficiencies going.
All right, viewers, remember petcoke is also very much important raw material, and Anuj just discussed about the raw material pricing for petcoke as well for cement companies like JK Cement. But Anuj, you are a man of strategy. You spoke about the operational efficiencies. Now, when does these benefits actually come in? Can you just give me a timeline for it? Because there is some operational programs also which is being undertaken at JK Cement, to get the efficiencies up. So, just need to give the entire details about it. But when can the benefits start coming in?
So it's already being realized. As I said, 2 years back, we had taken a target of around 150 rupee per ton. We are already 80% down the road. It's realized, but it's always a time to keep relooking at the targets and take the next journey. Overall, we are again trying to get around a 50 to 100 rupee benefit even next year. But as you go on doing the projects, the returns becomes more difficult. But that's a challenge which we are relishing. But to answer
Yeah.
your specific question, whatever target we had taken 2 years back, 80% is already in the bag.
Okay, so 80% is already done. I was just checking the capex numbers, and that's on the higher side for FY27. And definitely, this plan which you have given, you are sticking to that, or any changes you guys expect for FY27, 28?
No, we are sticking to that. The capex is see, the growth has also been fueled in our company through steady capacity expansions. This year, we are going to do around 2,500 crores or so, basically, which is divided into two parts: the completion of all the projects in Central India and taking up the new big expansion in Jaisalmer and the associated grinding units. Next year will be a peaking capex year because the setup in Jaisalmer and the two grinding units, the most of the spends will in a way take place next year. And so we are definitely sticking to the guidance. We are quite clear that we have to do capex, but very cautiously but steadily, so that the capacity increases, net debt is in control, and we keep growing.
And Anuj, one more query is there regarding the overall demand trends, for North India and Central India. Let's divide the conversation. For North India, any price hikes, or for Central India, because the demand is strong as per your con call in Q3. So just give your perspective on both the Northern India and the Central India.
So, I mean, it's easier to talk about demand because pricing is dependent on a lot of factors, demand being, of course, one of the primary drivers as well. North India, very, very surprisingly, first 6 to 7 months, the demand was very muted. But over the last 2 months, maybe you could call up a pent-up demand or whatever, but the last 2 months, the demand has been good and it continues to be quite strong. Central India, because, and by that we mean UP, MP, there's been a lot of development which has been taken up both in the private and the public sector, and hence it's growing steadily across the year. There was a good 7-8% steady growth throughout the year, and it continues. And we believe that given the low base of the Central India, that is going to continue as well. So North has been slightly fluctuating in demand this year, but Central India has been quite steady, as it has been the case for the last 2 to 3 years.
All right. And does this case change for the last 2 to 3 years? Because the industry itself was under a consolidation and it impacted you as well. Yeah, your company, I mean. But Anuj, will this kind of a uncertainty in the pricing, will it remain in the March quarter also? Because you sounded very bullish in the con call.
So see, at the end of the day, when the demand is good, it also helps pricing to some extent. So basically, it's more important to look at the demand picture. The demand in Q4 looks quite promising, and I believe that will augur well for the industry on all parameters.
Let's just revise the KYC rating for our viewers who have tuned in. Largely, JK Cement was in focus. A very strong set of operational numbers coming in Q3 as well. And let's just pull out the KYC ratings to understand the viewers what numbers I have given. A strong flow show in the cash flows, return ratios coming in, and net. Even the shareholding, that's where the FIs have increased the stake, and outlook is something which has done really well for the company. So I've given on the higher side of the ratings, it's 6 out of 8 for JK Cement as well. Thanks a lot, Anuj, for taking your time out and giving your views to NDTV Profit. Best of luck for the future. Thank you.
Thank you so much.
All right. So that's the management coming in for JK Cement, and stay tuned to NDTV, folks.